Palantir stock, ticker symbol PLTR. Certainly, it seems like it is one of the more popular stocks among retail investors. In fact, when I go onto YouTube, it seems like Palantir is everywhere these days, and a lot of the big YouTubers own Palantir stock. But when I dig into Palantir stock, I think it is overvalued, and I think it is significantly overvalued. I'll explain why in this video. Now, Palantir stock so far this year is up 140%. So I'm sure that my video coming out won't be very popular among Palantir shareholders, but this is my personal opinion, and I try to provide transparency and just my honest opinion and valuation on stocks. In this video, I'm going to go over an overview of what Palantir does, what kind of business model they have. We're going to talk about financials, and I'm going to give you guys my valuation on Palantir stock. To dig into the business, we're going to go right to their 10K for 2022. So Palantir builds software that empowers organizations to effectively integrate their data, decisions, and operations at scale. Founded in 2003, they started building software for intelligence community. The company went public in September 2020. They have three principal software platforms: Gotham, Foundry, and Apollo. For over a decade, their Gotham platform has surfaced insights for global defense agencies, the intelligence community, disaster relief organizations, and beyond. Their Foundry platform is becoming a central operating system not only for individual institutions, but also for entire industries, where the Apollo platform is a cloud agnostic, single control layer that coordinates ongoing delivery of new features, security updates, and platform configurations, helping to ensure the continuous operation of critical systems and allowing their customers to run their software in virtually any environment. The company has had some exciting bookings wins lately, announcing in May that they won a multi-year contract with the United Special Operations Command worth $463 million. During the last quarter, the company closed 66 deals of at least $1 million. 30 of which were at least $5 million and 18 were at least $10 million. Most recently, the company announced in October that they won a $250 million award with the Department of Defense that will span about 3 years. They work with many of the world's leading government and commercial institutions. As of December 31, 2022, they had 367 customers. Software is currently used across 60 different industries around the world. About $1.9 billion in revenue the company made in 2022. 56% came from customers in the government segment and 44% came from customers in the commercial segment. In 2022, 61% of the revenue was from customers in the US and 39% was outside the US. The top 20 customers represented about 52% of their total revenue. Here in a second, we're going to take a deep dive into the financial history and just the financial metrics in general of Palantir. But first, I do want to talk about stock-based compensation because this is very important, I think, for Palantir shareholders to really understand the impact it makes to the P&L and also the cash flow statement. Palantir is a software company, and a lot of times these software companies use stock-based compensation to attract potential employees to their organization, but Palantir has paid out a lot in stock compensation. In fact, you can see in 2021, they paid out $778 million in stock compensation. 2022, it was about $564 million. That is a decrease of 27%, but I think it is important to keep this in the back of your mind before we get into the financials. And as we take a look at the financials here in a second, you will notice that the operating margins have increased for the business, but a big piece of that are the stock-based compensation pieces. And if you're wondering why that has been going down year over year, the decrease was primarily driven by forfeitures and lower expense under accelerated attribution method for RSUs granted prior to September 30th, 2020, the date of their direct listing, during the year ending in December 31, 2022, compared to the same period in 2021, partially offset by an increase related to awards granted after December 31, 2021. So these numbers will certainly impact the operating margins and the free cash flow of the business, and you'll see here why in a second. So I typically like to show about a 10-year financial history of a company. Now, keep in mind, Palantir came public in 2020, so I can't go back and look at previous numbers. So we'll just have to look at the last few years as a comparison. Now, from a sales per share standpoint, it has increased about 17% per year, going from 60 cents back in 2020 to about 95 cents the last trailing 12 months. Now, earnings per share has increased substantially, about 68% per year. Now, they were at negative 64 cents in 2020, and they're negative 2 cents over the trailing 12 months. And some of you may be saying, well, I don't understand that because sales has actually increased over 30% during that same time frame. Why are you saying only 17%? You may have also seen that earnings has grown greater than 68% as well. But keep in mind, this is on a per share basis. This is what I like to look at when I'm evaluating companies, because like Palantir and other companies that issue a lot of shares, it is going to reduce your piece of the pie going into the future for shareholders. So a company that may have 50% growth on the top line, if they're selling a bunch of shares, they may only have a growth on a sales per share basis, maybe even half that. And that's what we're kind of seeing here with Palantir. Because ultimately, as a shareholder, you want to know what your piece of the pie is worth and potentially what it's going to grow in the future. Now, free cash flow per share, my formula here is kind of bombing out because it's taking a negative divided by a positive, but it has grown quite a bit during that time. Book value per share has grown from 84 cents to $1.41. That's about a growth of 19% per year. Now, return on invested capital has been negative over the last 3 years, but is trending in the right direction, going from negative 59% to negative 1% over the last 3 years. Now, as far as their balance sheet goes, it is fantastic. It is one of the best balance sheets you can find out in the market, period. They have little to no debt at all. So my long-term debt payoff is zero because they have no long-term debt. Now, their debt to equity is only 8%. If it's under 50%, that is really tremendous. So seeing it at only 8%, that is incredible. I think Google is actually something similar to Palantir, and their current ratio, which looks at current assets to current liabilities, is a 5.2. So that means they have 5 times as many current assets as current liabilities on their balance sheet, which is absolutely tremendous. That is fantastic overall. Now, as far as a multiple for this company, it has been, well, it's been basically zero. I'm showing negative here because it's taking enterprise value and dividing it by EBIT, which suggests that the operating income of the business has been negative. Now, gross margins for the company over the last couple of years have been actually very consistent, around 78 to 79%. Operating margins, even though they've been negative, they have been improving substantially year over year, going from negative 107%, negative 27%, negative 8%, then negative 3%. So again, even though it's negative, you're seeing things trend in the right direction. Same thing with return on invested capital. Now, during that same time frame, their enterprise value has gone from 39 billion to 33 billion. And if you're wondering what enterprise value is, essentially market cap, and you subtract cash from the market cap, and then you add in debt, and that's how you get to the enterprise value. So you remember when I talked earlier in this video about stock-based compensation? I think it's really important for investors to be aware of that and just the impact to the income statement and the cash flow statement. So stock-based compensation, from a GAAP standard, they have to add that in as an expense on the P&L. So it does subtract from profit or add to loss, depending on how that falls out. But from the cash flow statement, that actually gets added back in because it's not actually a cash transaction for the business right now. It's going to be in the future. Right now, it's not. So it's actually added back in. So it increases cash from operations and increases free cash flow. So if we look at this consolidated statement of cash flows, which is the cash flow statement, you can see cash from operations is $206 million for 2022. It was $333 million in 2021. So that's positive. So that looks good. And if you even subtract out the property and equipment of $40 million, you're still positive free cash flow. However, my opinion is that stock-based compensation should be subtracted from cash from operations. So this means that instead of having a positive $233 million of cash from operations in 2022, it would indicate that cash from operations would have been negative by over $300 million, which also means that free cash flow was negative by $350 million for 2022. Now, not everyone will agree with this approach, and I get that, but in my mind, stock-based compensation is a real expense of the business and is typically ignored by a lot of investors. In many cases, the company is already committed to paying out these obligations, so future free cash flow will be significantly impacted, especially when it comes to companies like Palantir, because of the large compensation pool they have already given out. So that means future free cash flow is going to be degraded because of the stock-based compensation that's out there, which is very important when we do our valuations here in a second. Something else I found very interesting about Palantir is that since 2021, the company has purchased approximately $326 million worth of shares of other companies. These various entities that are privately held, publicly held, and some are special purpose acquisition companies. During 2022 alone, they purchased $124 million of shares from 6 entities, which you can see on the screen right here. In addition, the company purchased $51 million of 100-ounce gold bars in 2021. The gold bars are kept secure in a third-party facility in the northeast portion of the United States. I think it is important to be aware of these types of investments because $400 million between the gold bars and the shares of the other companies are not small purchases and could have a negative impact to the P&L if these values fall. This would be a write-off to the asset on the balance sheet if they went down, decreasing profits in a future period. You could also have the reversal effect if the value goes up, but either way, it's good to know that these values are there. Okay, now let's take a look at our first valuation model, and this is my margin of safety calculator. So I'm trying to come up with a good earnings per share basis for Palantir, try to project out what I think the earnings growth is going to be, and I'm coming up with a 23 cents EPS for Palantir, what I think is normalized for the business right now. I think it's going to grow about 25% per year, so very significant growth for Palantir. So based on the information, I come with a target buy price of about $8 here today. Next up, we're going to be taking a look at my discounted operating earnings model. What I'm doing here is I'm projecting out operating earnings of the company, discounting it back today to get my net present value of future earnings, and then from there try to figure out what the intrinsic share price of the business is based on the market multiple on what the market is willing to pay for this type of business. So first, I need to figure out what this future sales is going to be for Palantir. So I think it's going to be about 20% per year. Now, keep in mind, we looked at the previous slide where it actually showed the growth from a CAGR basis for sales per share was at 17%. So I'm actually being very optimistic with Palantir, putting it a 20% growth rate over the next 5 years. I think the market multiple is going to be around a 30. There's certainly some negotiation or argument on what that might be, but I'm using a multiple of 30, which is very, very high, and I usually don't even use that type of high of a business unless I'm looking at a Microsoft or a very well-established business that has years and years track record of very, very positive earnings. And history has shown us that the market has been willing to pay a high multiple. So again, I'm trying to be very optimistic with Palantir, and I'm saying a 30. Not only that, but I'm saying operating margins are going to significantly grow for this business. So they were at negative 8% last year. I think they're going to be around negative 3% this year. I think it's going to grow all the way up to 25% operating margins in 2027. So based on all this information, I come with intrinsic share price of $9 today. Next up, let's take a look at the 10 cap valuation. So this is a Phil Town valuation. If you're familiar with him, he actually learned this valuation from Warren Buffett. This is how Warren Buffett values land. And he's talked about in a past annual Berkshire Hathaway meeting. So what we're trying to do is trying to figure out operating earnings of the business is, and we don't want to pay 10 times the operating earnings of the business. So operating earnings, essentially free cash flow of a business. So I think the operating or cash from operations from the business is around $450 million. I think a standard capital expenditure for a business is around $40 million. I think their tax provision normalizes around $20 million. So that gives me total owner's earnings of about $430 million. So based on about $2 billion of shares outstanding, I get a buy price of $2 here today. The last valuation template we're going to take a look at is the payback time calculator. This is another Phil Town valuation template. This one here says, hey, I want to be able to put money into a company and get my money back within 8 years. Well, why 8 years? Simply, if you look at historical means for the market has been willing to get their money back in 16 years. So on average, the PE of companies across all different industries over the last several decades has been a 16. So if we can get it for an 8, that usually means, or hopefully means, that there's enough margin of safety in this stock to get our money back about twice as fast as what the market is willing to pay. So here I'm saying free cash flow of the business is roughly around $410 million. We saw owner's earnings of $430 million on the previous slide. Technically, that also adds in the tax provision, so that's kind of why there's a difference here. So free cash flow, I'm saying $410 million. I'm saying 35% growth for free cash flow. So I'm saying significant growth for Palantir. But based on that, I get a payback time of 11 years. So that is higher than the 8 years of what I'm looking to get or requiring to get from a stock. So we look at a quick summary of all those valuation templates. For my discounted operating earnings model, I have a fair value of the stock at $9. So I have a buy price at a 30% margin of safety, because again, these are a lot of assumptions going into these models. Am I going to be wrong in some of them? Sure, I'm going to be wrong. So I want to have a margin of safety there. So I want at least a 30%, which is a buy price of $6. The payback time model suggests buying at $7. 10 cap says buy it at $2. The margin of safety calculator says buy it at $8. But nonetheless, all these are significantly below the stock price of $15 here today. So if we take this a step further and try to figure out what the return on investment of the stock is, this is how I'm looking at. This is really based on my discounted operating earnings model. So if the stock was at $5, I would expect a 25% return from the stock. If the stock is, say, at $9, I would expect a 10% return. If the stock is at $11, I would expect a 5% return. So with it being at $15 here today, I'm expecting very little return over the next several years. And that is based on a sales CAGR of 20%, operating margins of getting to 25%, and then a market multiple of 30. So those are my thoughts about Palantir. Now, I want to be very clear here. I think that the stock is overvalued at this time. I think Palantir as a business is absolutely incredible. I could see myself owning it at some point in time, but right now it makes absolutely no sense from my point of view based on the current stock price. Could I be wrong? Maybe. Tell me in the comment section below, what do you think Palantir is worth right now? I'd love to hear from you guys down there. Thank you so much for watching. If you got some value out of this video, go ahead and hit the like button on the way out. If you don't know how to value stocks, I offer valuation templates on my Patreon. I'll put a link down below if you want to go check that out. You also get access to my Discord channel as well. Thanks again for watching. Really appreciate it. I'll catch you guys on the other side. Take care and God bless.